Hey, what is up guys? This is dude-diligence here. This is just going to be one of those reflection things where I talk because I just finished working out. You see, I just got my jacket on and just finished working out. And I checked the market a little bit and I liquidated, in the morning I liquidated some of the SQQQ contracts. For those of you who don't know what SQQQ is, it's basically actively shorting NASDAQ or shorting the market in the short term. Which I stressed it a lot during my videos. I talked a lot about why interest rate really important, and if interest rate goes up, it's really going to hit the equity market really hard, on which the earliest news we're going to get from Fed is actually next week. So then this week, the market is going to be really volatile. So last week I talked about maybe it's a good idea for SQQQ, UVXY, and maybe VIX. And then right now, all of those contracts are 100% up. So then I decided to liquidate them. And you guys are like, oh, did you just double your account? No, I didn't, because I am no longer as reckless as before. Again, this video, for those of you who might watch or might concern, this journey of trading for me right now is more about risk management and risk hedging at this point. So a lot of you are like, oh my God, if you keep making those trades, you're going to double your account in no time. Yes, but the thing is, what is very interesting about the psychology of when market is going down is whenever the market goes down under a key point, a lot of investors' psychology is, oh my God, we should buy the dip right now. But the problem with that is a lot of big time institutions like to stack up their short position on the way of going towards bottom. And really nobody really understands the bottom. So as a a new peasant retail, our job is to minimize our risk and preserve profit. Let's just say today you bought $7 call SQQQ like I did last weekend or last Friday. It's 100% up, and what you should do is you should at least liquidate half of those things like I did. I actually liquidated 90% of all those contracts. Because think about it, right? Most likely, the probability of when NASDAQ goes down the key point 150 EMA, which is just exponential moving average. For those of you who want an explanation on what is exponential moving average, I will make a video on that. Sorry about all of these education content. Work, class, honestly, master class is kind of stupid. If you want to hear me rant about that, I will make a separate video about why, if you really want to make money, a graduated college is already enough, especially if you are a US citizen, and there are certain jobs that you should go into or certain majors that if you want to make money, you should go into, and then master's is not really worth it unless you've been working for a company for a while and they sponsor your master's or MBA, and then they will give you a significant salary bump. Other than that, in a situation like this, when the market is going down, when inflation is going up, the educational expenses are actually highly discounted in terms of its value. But anyway, so the market is going down. So what you should think right now is, hey, if tomorrow rebound, what am I supposed to do? I mean, it's super ultra risky today to stack up your short positions. Why? Because this is a Monday and a lot of put options just came in. That means the market maker already hedged for the put options by selling more of their shares. And when they're selling their more of shares, that means today might be the lowest point of this week. But on the contrary, the interesting part about tomorrow is about on Wednesday. Wednesday are usually the expiration for VIX and volatility indexes, and Wednesday are usually the day where Fed sometimes come out and give you some document or some discussion about the economy. And usually on a Thursday afternoon, the market will trade flat. That means if you stack up short position and if you just exited like one day after, you actually can make a small amount of profit. But the only problem of today buying more shorts, or just I think it's just one of my confirmation bias, or I'd rather have cash on hand, is because you can't really predict what most investors are thinking. All right. Let's just be honest. Nobody have the money. Nobody have the dry powder. If you are a retail investor, you were not in my Discord. A lot of my Discord members actually have a lot of dry powders. I try to convince them not to go in too early because nobody likes to short. Let's just be honest, right? According to market census or according to market analysis or sentiment analysis that a lot of universities conducted on investors, most investors don't like to short because the shorters or people who intend to short or people who are shorting a stock during a uptime, they're the sweatiest people. And then the shorters who are shorting the stock when the stock actually is going down actually are sweatier than the people who are buying in. Why? Because people like Warren Buffett have billions and billions of dollars out there just lying around cash. The reason why Berkshire Hathaway is going to be one of the best investment you will make during this downturn or when this downturn is over is because Berkshire Hathaway actually have at least 60% cash just on hand. They're not investing it, they're waiting for the bottom to hit. This is why a lot of times when people are chasing bottoms, you guys are like, oh, we only know about chasing tops. Yeah, they're chasing bottoms. Some people like to double up and triple down on their short positions. And that's bad. That's really bad. That's even a worse risk management than buying call options indefinitely. Because statistically speaking, you have a 60% edge when you're buying calls than you're buying puts. When you're buying puts, yes, the market is more volatile. It's more probability that you're going to make more money. But at the same time, the probability of you lose money in the long run is really, really high. Therefore, whenever you have a put contract and then it gets over a certain point, let's just say 50%, I'm just pulling up my ass right now because it's really personal preference. Because when you're trading options, a lot of times it's not really like a real-time gap up or gap down. They usually determine the price of an option usually are predetermined pre-market, but when pre-market start, you cannot really trade it because a lot of those option supply and demand are purely based on sentiment. Okay. Anyways, this is it for the video. It's more like a reflection for myself. I'm going to put more of those selfie videos, not because I just got a new phone for my godmother as my birthday present. Yes, I was born on January 1st. Yes, it's a really great birthday. Thank you. If you want to send us something, I will maybe put a P.O. box down below somewhere if we set it up or something. But anyway, see you guys on the upside. Hopefully this sort of ease your confusion a little bit. Again, if you just wait until the first Fed announcement of the interest rate hike and you just buy back in on that specific day, you will actually have a significant upside in the next 3 months after you do that. So right now, what we're trading, if you are buying puts or you're trading shorts, it's actually very, very dangerous in terms of how the leverage works. But again, you still have a lot of wiggle room to short because TQQQ is not. So for those of you who don't know what TQQ is, it's a leveraged index for NASDAQ, right? And then everybody knows that when NASDAQ goes down under 150 average, TQQQ's leverage basically get chopped. And then when TQQ's leverage get chopped, you have about a week or 2 weeks interval that you can make money shorting. The only problem is just how VIX will react and then how Fed will leak things, and maybe government officials will come up and say, hey guys, it's not really that bad, and because people are sheep, they're just gonna be like, oh my god, it's not that bad, and they pay back in, and then your option contract's gonna be worthless. But the funny thing is, if you just buy a month or maybe 2 weeks longer of an option contract, means the expiration date is 2 weeks or a month later, you might actually make double amount of money. This is the tragic thing about trading options. Timing is the most important thing, and there are a lot of people who like to put out smoke screens and then just basically cut off retail's head. That's just how life works, because retail money is the easiest one to win in the market. And I've been interviewing and talking to a lot of institutional investors, and I'm getting a lot of new perspective on how the market works. And I honestly don't believe there's such thing as market manipulation. It's all fair game at this point. There are a lot of things, there are a lot of underlying things under the surface that you and I do not see. But the more you're in the industry, the more you dig deeper and you realize, oh, that kind of makes sense. Because majority of the market is still traded by institutions, and there are rules that retail investors don't understand. And it will be really easy to just start buying call options when the market is going up, and everybody will make money. And then you have a lot of YouTubers online and saying, oh my god, all you have to do is just sell puts in an upturn market. Alright guys, enough with playing with chroma key and talking about selling puts and being salty. I think my phone just went out of battery, and then just for those of you guys who really want to hear me ramble about selling puts, basically in the last part of that video, which was not recorded, I talk about why it's kind of a stupid idea to sell puts all the time, and then you're going to get completely wiped off when there's a market correction. But anyway, this is it for this video. And again, we're not financial advisors. We do not give financial advices. Everything we say on this channel is for shits and giggles only. See you guys on the upside. If you like those kind of video, smash a like button and subscribe. And if you want to support us, you can join our Patreon. It's only $5 per month. And in our Patreon exclusive Discord chat, we talk about a lot of stock tickers. And sometimes we send out a lot of warning signs and all those kind of stuff. And we actively talk about certain tickers. We actively talk about sometimes when certain information are out, we are a little bit faster than regular media. Well, way faster than regular media, and we make reactions. And sometimes we have a lot of active people in Patreon. Some of them are actively shorters by input. Some of them are really big on the meme stocks. There are a lot of perspective in there. So it'll be really good for you guys to just look at what our different perspectives are there. And sometimes I comment, most of the time I comment on a lot of things and on a lot of trades. And then, if you talk to them, they realize that nowadays I becomes more and more risk averse, and then I focus a lot on risk management. And then my job is to remind my Patreon members that, hey, you guys are playing too big, maybe it's too risky, it's time to tune down, or is it time to scale, to trim, or is it time to double down? All right, see you guys on the upside. Bye.